The old safety net may be gone. For decades, investors were told one simple thing. If stocks get hit, bonds will catch you. But the man running the world's biggest bank is warning that this time, both sides of that trade could break at once. And if he is right, a lot of portfolios are built for a world that no longer exists. Jamie Dimon's latest shareholder letter does not read like the usual polished corporate optimism. Buried inside it is a much darker message. JPMorgan is preparing for a scenario where sticky inflation, energy shocks, and hidden credit stress collide at the same time. And that matters because this is exactly the kind of setup that destroys the logic behind the classic 60-40 portfolio. For around 40 years, that model was treated like the foundation of sensible investing. 60% in stocks for growth, 40% in government bonds for protection. The whole thing depended on one key relationship. When stocks fell, bonds were supposed to rise. That inverse relationship was the engine. Growth slows, equities sell off, investors rush into government debt, bond prices rise, and the portfolio stabilizes. That was the promise. That was the parachute. From roughly 1980 to 2021, the correlation between stocks and bonds averaged around -0. Financial advisors built careers on that. Pension funds built strategies on that. Central banks reinforced it by cutting rates whenever the economy started to crack, which pushed bond yields lower and bond prices higher during equity panics. And while all of that was happening, the institutions sitting at the center of the system became enormous. JPMorgan Chase now holds roughly $425 trillion in total assets. So when a bank operating at that scale starts pointing to a structural flaw in the system, people should probably pay attention. Because the entire wealth management industry was built on the assumption that inflation would stay under control. That only works in a world where supply chains function, geopolitical shocks stay contained, and central banks can respond the way they used to. That is not the world we are in now. The warning signs were already there in 2022, when the 60-40 portfolio suffered its worst annual performance in 150 years. And it took until June 2025 just to climb back to its previous highs. That tells you how brutal it is when stocks and bonds start falling together instead of offsetting each other. Now Dimon is arguing that this was not a one-off shock. It may have been the start of a regime change. In the 2026 JPMorgan shareholder letter, he described sticky inflation as the skunk at the party. The point was simple. Inflation may not drift gently back to target. Could stay embedded. Could even move higher. And he tied that risk directly to the conflict involving Iran and the fracture of global supply chains. With disruption in the Strait of Hormuz affecting the flow of global energy, Brent crude spiked to around $119 per barrel in April. That kind of move does not stay contained inside oil markets. It ripples through transport, fertilizer, manufacturing, food, and pretty much everything else. Dimon drew comparisons to 1974 and 1982 for a reason. Those were periods shaped by rising oil prices and persistent inflation. In that kind of environment, stocks lose real purchasing power and bonds get hit too, because inflation erodes the value of fixed income payments. That is the stagflation trap. Low growth, high prices, no easy escape. And this is where the traditional portfolio model stops working. If inflation stays elevated, central banks cannot simply slash interest rates to rescue the market. Rates stay higher. Higher rates pressure equity valuations. At the same time, they hammer long-duration bonds. So both sides of the portfolio start moving the wrong way together. That is not theory anymore. We are already seeing it. The U.S. 10-year Treasury yield recently climbed to 4.37%, while the yield curve moved back to a normal shape after being inverted. The spread between the 10-year and the 2-year Treasury returned to a positive term premium, which basically means bond traders are demanding more compensation to lend over longer periods. That fits with one big fear. Inflation is not going away cleanly. The result is obvious. Long-duration Treasury bond funds lost more than 2% in a single month. At the same time, the S&P 500 fell roughly 3.6% from the start of the year. Stocks down, bonds down, both under pressure for the same reason. And the correlation has violently flipped. Instead of protecting each other, Bonds and stocks are now moving together with a positive 60% correlation. That is a massive change. At the start of the year, retail investors were still expecting the Federal Reserve to cut rates several times. In January, the market had priced in at least 2 cuts for 2026. But as CPI stayed stubbornly above target, that optimism faded fast. Now the market is pricing in 0 rate cuts for the rest of 2026, and some analysts think meaningful relief may not come until late 2027. So the old playbook is cracking. Easy money is gone. The safe haven assumption is breaking. And that is only one side of the problem. Because Dimon also pointed to something Wall Street would rather not talk about too loudly: the private credit market. Before we go further, one quick thing. If you want regular breakdowns of global markets, commodities, macro trends, and monetary policy without having to dig through all the noise yourself, the Coin Bureau Finance newsletter is worth keeping on your radar. It is free and it is built for moments exactly like this. The link is in the description, and you can scan the QR code on screen. Now, back to the part that should worry people. Dimon warned that losses in the private credit market could come in much higher than expected because underwriting standards have been far too loose for too long. This shadow banking system has grown to around $1.8 trillion in assets under management. And unlike public bond markets, this stuff is much harder to see clearly. These loans are often illiquid. Many are not rated in the traditional sense. Valuations are much less transparent. Over the last decade, alternative asset managers piled in, pushing loans into mid-market companies based on increasingly aggressive assumptions about future growth. But the underlying health of those borrowers has deteriorated badly over the past 2 years. The median interest coverage ratio for private credit borrowers has fallen to about 1.6 times earnings. That means nearly half of these companies are generating barely enough cash to cover the interest on their debt. Not the principal, just the interest. And it gets worse. Roughly 70% of new private credit issuance is now considered covenant light. In plain English, that means many of the early warning protections lenders used to rely on have been stripped away. Fewer tripwires, less intervention, more room for problems to fester until they become much harder to contain. Morgan Stanley analysts project that private credit default rates could rise to 8% between late 2026 and early 2027. That is way above the long-term average of 2%. And it lines up with Dimon's point that future losses are being underestimated. To keep the appearance of stability alive, lenders have increasingly leaned on payment-in-kind structures. That allows struggling borrowers to pay interest with more debt instead of cash. So on paper, income still appears to be coming in. In reality, the system is generating phantom earnings. That phantom income now makes up nearly 10% of total investment earnings for major business development companies. That is not resilience. That is accounting fog. Dimon had already been sounding alarms about this back in October 2025, after several subprime lenders went bankrupt. That was when he made the now famous point that if you see one cockroach in the system, there are probably many more hiding behind the walls. And that brings us to the liquidity problem. In the first quarter of 2026, BlackRock's $26 billion corporate lending fund was hit by a wave of redemption requests. Investors tried to pull about $1.2 billion in a single quarter. But the underlying loans could not be sold quickly without taking serious losses. So the fund did what these vehicles do when reality catches up. It gated withdrawals. Redemptions were capped at the 5% limit. Only part of the money came out. Hundreds of millions stayed trapped. That is the danger with illiquid assets packaged for investors who assume they can get out when they want. Everything feels stable until too many people head for the exit at once. And once that starts, contagion becomes the real story. Because if these loans begin defaulting in size, the damage does not stay neatly inside a few private funds. One of the biggest transmission channels runs through insurance companies. U.S. life and annuity insurers have doubled their exposure to these opaque corporate loans over the last decade. These alternative assets now make up around 35% of total investments for the domestic insurance industry. Dimon's warning is that regulators may eventually force tougher ratings treatment and capital markdowns on these portfolios. If that happens, insurers could face capital calls and forced selling. Not a dramatic overnight collapse. Something slower, more grinding, more corrosive. The kind of damage that eats away at retirement security without grabbing headlines right away. There is another layer to this too. Around 26% of direct lending portfolios are concentrated in software and technology companies. And now those same companies are facing disruption from generative AI, which is starting to pressure the subscription models many of them depend on. So now you have high rates, weaker cash flows, deteriorating collateral, and a major technology shock arriving at the same time. That is how defaults spread. And this all feeds into a broader paradox in the economy. Because what we are seeing now looks more and more like a two-speed system. At the top end, hyperscale AI investment is driving enormous profits and spending. The 5 biggest tech giants are projected to spend almost $700 billion on data centers and specialized semiconductors in 2026 alone. That is a staggering concentration of capital. A tiny cluster of companies is pulling the major indices higher, which creates the impression that the broader economy is stronger than it really is. But underneath that headline strength, the picture looks very different. Entry-level job postings are down roughly 35% since January 2023. Junior hiring is getting cut. Training programs are being shelved. Companies are using uncertainty and automation as reasons to pull back. So while a small corner of the market surges on AI infrastructure, the average worker is facing a much tighter and more unstable labor market. Then there is the cost of living pressure. The energy sector ETF is up nearly 30% from the start of the year. Consumer discretionary is down more than 8%, which suggests households are pulling back on non-essential spending. That is exactly what you would expect when essential costs keep climbing and wages do not keep pace. And some of the worst pressure points are the ones central banks cannot really fix. Home insurance premiums have jumped around 46% since 2021. Diesel prices have moved higher too, which acts like a hidden tax on nearly everything transported through the economy. Every trucked-in product carries that cost. Every grocery bill reflects it. Mortgage rates are pushing back towards 6.5% on the 30-year, freezing the housing market and making it even harder for first-time buyers to get in. All of this is happening while the fiscal backdrop gets more fragile. U.S. national debt has now crossed $39 trillion. The annual interest bill required just to service that debt has moved above the entire national defense budget. That matters because once debt servicing starts consuming that much fiscal space, the pressure to keep the system liquid only increases. And that is where the idea of fiscal dominance starts to matter. The government keeps spending. More currency gets pushed into the system. Consumer prices stay under pressure. Meanwhile, the Fed is boxed in because cutting rates too fast risks reigniting inflation, while keeping rates high increases the strain everywhere else. So the so-called soft landing starts to look less like a plan and more like a hope. And the biggest institutions are not positioning as though everything is fine. They are preparing for a longer period of volatility and wealth destruction. Some analysts call it a triple red scenario, where equities, bonds, and currency all weaken together. That is one of the rarest and most destructive setups for preserving wealth. Which is why institutional capital is rotating toward hard assets, commodities, and critical infrastructure, while a lot of the public is still sitting in the same 60-40 framework that worked in a completely different era. That era is ending. Frictionless global trade is no longer guaranteed. Easy monetary policy is no longer guaranteed. Even the definition of a safe haven is no longer guaranteed. And when the CEO of the world's largest bank starts saying the illusion of safety has broken, that is not something ordinary investors should shrug off. The message from the market is getting louder. The old defenses are failing. Stagflation is no longer a distant historical case study. It is becoming a live portfolio problem. And the ugly part is this: when the system finally reprices that reality, the cost does not get absorbed by abstractions. It lands on households, on retirement accounts, on insurance holders, on workers, on anyone still trusting a model that was designed for a calmer world. So here is the real question. Do you think the Fed can still steer this back under control? Or are we already too deep into a regime where both stocks and bonds stay vulnerable at the same time? Drop your view below. I want to know whether you think this ends in policy rescue, or in a much harsher reset. And if you want to see how the biggest asset manager on earth is positioning for this exact kind of world, watch our video on Larry Fink's secret agenda next.